Hey everybody, Marty Mazzora here. It's the 26th of April, 2024. This is your weekly economic update. Going to share a few of the inputs to our index, which dropped 2 points to negative 11, 10.87 to be exact. So we almost pushed our way here 2 or 3 weeks ago into the positive, which would suggest that the expansion is still good to go, but we really never got there, and we're rolling back over a bit, suggesting that recession odds remain too high to ignore going forward, despite a lot of the data that understandably has folks believing that indeed we will see a soft landing of this economy, and that would be ultimately inflation coming down and no recession. Our work says still very narrow path to that outcome. Open to that possibility. We'll continue to assess and analyze the macro as it unfolds over the coming weeks and months and report to you at least once a week. So let's just get into some of the inputs, and then I do want to hit the market again. Stocks, the dollar, yields, and gold. Same thing we did last week. I just kind of want to update you on what we were looking at then versus 1 week later. I thought I'd start, though, with the Economic Surprise Index for the U.S. You can see it has rolled over. It looks kind of like our PWA index chart now. It's a very different animal. This is simply actual data that's come out relative to what economists had previously expected. So you can see what the trend has been of late. U.S. GDP was released this week. First quarter, it came in at 1.6% annualized. I'll share with you here just briefly my own notes yesterday in our internal log with regard to GDP. While weaker than expected, when we take out the negative effects of inventory drawdowns and the particularly benign net exports, meaning imports actually rose, we're left with 2.8% real final domestic demand and 3.1% real final private, which would be ex-government demand. I.e., while I'm fairly certain real weakness is on the not too distant horizon, things do look okay based on this report. Although, or however, I can't say that, while not overly alarming just yet, the details around consumer spending, other than in relation to imports, I can't say that they reflect a necessarily strong economy. And here's directly from the report, just copied and pasted. The increase in consumer spending reflected an increase in services that was partly offset by a decrease in goods. Services were primarily increases in healthcare and financial services and insurance. Within goods, the decrease primarily reflected decreases in motor vehicle purchases and parts, as well as in gasoline purchases and other energy goods. Within residential fixed investment, the increase was led by brokers' commissions and other ownership transfer costs, as well as new single-family housing construction. The increase in non-residential fixed investment mainly reflected an increase in intellectual property products. The increase in state and local government spending reflected an increase in compensation of government employees. The decrease in inventory investment primarily reflected decreases in wholesale trade and manufacturing. Within the imports, this would be the positive for spending. The increase reflected an increase in both goods and services. So again, nothing to say that recession is imminent, but just maybe something that's not so positive looking when you just focus on the headlines and the news releases. But it was interesting, though, because again, GDP came in a little bit weak relative to expectations, but the markets utterly tanked. I think the NASDAQ was down over 2% in the morning, and the S&P wasn't far from that. Now, they recovered a great deal of that by the end of the day, and part of the NASDAQ's hit was Meta, or Facebook's disappointing outlook for CapEx spending, meaning Facebook essentially said, we've got a ton of money to spend on AI going forward, and we're not really making any money from it yet, and it's going to take a while. So they basically told the truth. This is something that we've talked about here and I've written about here over the last year or so, that the NVIDIAs of the world are making a ton of money because a ton of money is being spent. However, we're yet to see where that's ultimately going to lead to profitability. I think it ultimately will, and it should lead to a great deal of productivity in the long run, but we're just not seeing that yet. So it kind of calls into question kind of the go forward mania, if you will, or euphoria around everything that is artificial intelligence. Of course, all eyes were on the inflation data, and it was hotter than last month. This is the headline at 2.7 off of 2.5. The core inched down a little bit. That X's out food and energy, but still notably above the Fed's target at 2.82. Month over month increase 0.32%. So pretty much as anticipated, maybe a little hotter. It should have been a big concern, but we had very positive results from Google or Alphabet and Microsoft. And Alphabet started paying a dividend for the first time, going to buy back a bunch of shares. This is all direct shareholder largesse that the market seems to love when it comes about. Ultimately, what we're going to be looking for are earnings in the coming quarters. The one thing that we downgraded this week that led to the 2-point decline in our index was actually consumer confidence. And even though it doesn't look horrible, it's beginning to roll over a bit here on the University of Michigan survey. That just came out today as well, their latest review of the most recent survey. And the reason that's of growing concern, first of all, the 77.2 versus the print in March was 79.4. Both of the main components fell month over month, and one-year inflation expectations actually ticked up to 3.2%, and that is too high, believe me, for the Fed to be cutting interest rates. And that's also the highest since last November. The 5 to 10-year guess was 3%, which was higher than the 2.8% in March. Higher gas prices were a main reason. Overall, consumers continue to express uncertainty about the future trajectory of the economy, pending the outcomes of the upcoming election. But at this time, there doesn't seem to be any evidence that global geopolitical factors are on the forefront of their minds. Also, consumers voiced modestly rising concerns over high prices again this month. So just negative trending sentiment is what we're getting. And I'm going to read from you again from the notes on the corporate earnings releases this week from Peter Bookvar, and basically you're going to find still just a very mixed picture out there. The Chicago Fed National Activity Index, it's an index within our index, was positive again, this time 0.15. 85 components, 50 were positive, 35 were negative in terms of their scoring of the index. That's not bad, and that's a incremental improvement over last month. Back to inflation. One of our indicators are inflation break-evens priced into CPI swaps. And you can see what the trajectory has been this year. And, right in here was where the Fed, Chairman Powell and company, were saying, look for some rate cuts, intimating that it would start as early as June. Well, today they're saying don't be looking for any rate cuts soon. The data, which is reflected right here as well in these inflation swaps, has shown higher than expected, more stubborn than expected inflation. And the Fed, many of them, even the doves, are saying, we're going to have to wait for more data to determine whether indeed it is time to begin cutting interest rates. They're not talking about raising them yet, but of course, ultimately this could go further, and that would have to be the conversation. And I can virtually promise you that would be no bueno for equity prices. We've been hitting a lot on commodities lately. Bloomberg Commodity Index was basically flat week over week, but you can see it looks like we're getting some divergent momentum here, so that'll be interesting to see if commodities do come down here a little bit going forward. I showed you copper last week. We had just an amazing breakout. Pretty much called it right back in here. We said we should expect that based on what we saw as bullish technicals. I said last week, don't be surprised if we don't get back a few percent. Well, last week we were right there, and we did come off of that a little bit, as you can see there on that chart during the week. But then right here at the end of the week, we spiked back up. So we'll see how that plays out. Still looks like that copper is a little technically extended right here. And then lastly, with regard to inputs, I just thought I'd show you the staples to discretionary indicators. So this goes up when staple stocks are outperforming discretionary stocks. And you think about why that would be an economic indicator. Consumer staples are the things that you're going to buy regardless of the economy, right? You got to buy staples to stay alive. Consumer discretionary items or things that you're going to buy when you have lots of discretionary income. And typically the market's going to reflect that activity. So when staples are doing way better as they have this year than discretionary stocks, well, that says something about the potential state of the economy going forward. Now, it's still a very wide gap. We're just almost 4 months into the year, and staples are outperforming discretionary by a solid, call it 7%, and it was all the way up here to about 9.5%. Just about 3 or 4 days ago. I mentioned the earnings from a couple of what would be called discretionary stocks here, and you can see that while staples continue to go up until the last couple of days, the market was up a bunch today, but nearly half of the S&P 500 was actually in the red, and staples ended in the red today. So, of course, consumer discretionary with those earnings that I mentioned, really had a big boost today, but they're still down 1.6% this year. So from the beginning of the year, those stocks in the aggregate are down. Wow, staples are up about 5%. So hence that difference of 6.6% between the two. So we'll see. But you tend to see this, prior to periods of economic weakness. But this here, the last week or so, is clearly more about earnings probably than it is about the economy. Okay, so let's talk stocks and technicals a little bit here. This is my chart of the S&P 500 index, and I just wanted to point out, first of all, that I said right here, look for a 5 to 15% pullback in the coming weeks. That's what the technicals were indicating. Well, right here, it was nearly a 6% pullback, like 5.6%. Then we got a real nice bounce off of that. So right here at just below 5,000, it was kind of a scary period right there. It looked like we were going to break below that. Came back. There's a candle right under here that brings us right up here that I'm pointing to. It's kind of covered up by my lines. Okay. So what does a 15% pullback look like? It looks like the S&P dropping down here to 4,500. Why would we say it's a 5 to 15% pullback? Well, the 5 is expressed right here because we had this support at 5,000, and then we bounced off of that. But notice what I've done here with these yellow lines. Folks, this is a pretty classic looking bear flag pattern to me. And it's classic because of the shape, notwithstanding that one candle here yesterday that fell below that, but we bounced right back into the flag part of this. And flags on average retrace about 50% of the fall, right? So if I start right here and I go down to the bottom and I go up, that blue line right there is 50%. And right under that yellow line is today's candle, which stopped right at that 50% retracement. Now, next week we have the Fed meeting, Tuesday and Wednesday, and that's going to be really interesting to see. The last meeting, there was hot inflation data. I really expected Chairman Powell to kind of stick it to the market, and he did not. He was very sanguine about the whole thing. Of course, he did pay respect to it, but said they fully expected inflation to go down. And the market kind of heard that as, yeah, we're going to cut rates. Well, the rhetoric from the Fed lately has walked back from that. So if he comes in hawkish, that's probably pretty problematic for stocks. By the way, I didn't mention it, but notice that green line right there. We didn't quite get there, but that's the 50-day moving average. So a little higher there would be a legitimate test of that, and we'll see. Right now, it's a bit of overhead resistance for the market as well. So anyway, so this next week we've got that. We have the jobs number on Friday. We're actually seeing weakness in the leading employment indicators. I don't know that that's going to show up this next week. If we have a hot jobs number, that's going to be problematic for stocks. If it's weak or pretty weak, and particularly wages, that's what they're going to be looking at again. If we see any softness in wage inflation, the market's going to love it. But I got to believe the Fed may be the biggest event next week. And then in terms of this bear flag pattern, by the way, I know I'm jumping around a bit, but where would that take us? That would take us just right here, almost to 4,800 on the S&P. And that looks like pretty important area right in there. You can see it was resistance, it was resistance, it was resistance. We bounced off of that, and we really haven't looked back. So a lot of commitments were made right in here that basically would provide potentially some support there. There's also this action right here at about 4,900 to 4,910. So if this bear flag does play out, it's not going to be a straight line. And it takes us right here again to this 4,800 You break that, you just got these spots that you're going to see I'm sure some hesitation on the way to where if we were really short-term traders, we might back up the truck a little bit here. And we may put some cash to work along the way anyway. We actually have had a pretty good run in our core portfolio because we're not entirely correlated to stocks. It was very interesting. This last week had to be the worst week of the year far and away. And our core portfolio actually held in there quite nicely. And it was because of the commodities exposure. This had to be, and I'm sure it was, the best week of the year this week. And we kind of hung in there, but we were relatively flat, just up a few basis points, while stocks went up because commodities, as I've suggested, gave back a little bit. And we'd made some adjustments to kind of limit and protect our exposure there here this week as well, because I'll show you here in a minute. We kind of anticipated things like gold backing off a little bit. But anyway, so some levels here now. If, for example, the Fed comes in dovish and the data softens a little bit, and if we had, weaker wage inflation, look out above. I mean, there's still a stomach to be buying stocks, particularly on soft data that might lead to cooling inflation sooner than people might otherwise think. And now when we look at our momentum indicators, I can't say there's bearish divergences here. I can't say bullish. They're just kind of moving right with the market. So if we really wanted to think about what the technicals say about the start of next week, we drill down to maybe the hourly chart. And when I do that, you can see here, these are each an hourly candle. That is a rising wedge. We have a gap right here, right? That would typically get filled, and so that would take us down here a little ways as well. This is not, I would not call that a bearish divergence. It would be if it was perfectly flat or if it sloped down. It would be here on the RSI. So this is leaning toward weakness at the beginning of next week, but nothing that I would make big bets on. We'll see. The bear flag pattern is pretty compelling, but absolutely unequivocally, that thing could easily fail on a catalyst. As for the NASDAQ 100, remember for weeks and weeks I was flagging this 20-day moving average, and as long as it continued to stay above that, that was pretty bullish. You can just see in the price here momentum beginning to wane. When I bring in the momentum indicators here, they were really rolling over. Remember I said this is a pretty ugly looking chart. And I think the NASDAQ, 7 or 8% decline in here from the peak. Of course, this looks like real bear flagging action as well. Very much so. And then, so it's the length of the flagpole. Would take us down in here somewhere. This 433 is key. We're talking internally today. I threw up a few charts in our internal communications here at PWA. And I said, that 433 is key. And sure enough, boom, we hit that, and that's where the rally ended today and came off of that a little bit. The hourly chart on the NASDAQ 100, we don't have, a bearish divergence. We're definitely overbought here a little bit, so we'll see. Wouldn't surprise me to see things, begin to come unwound a little bit at the beginning of the week. They certainly came off of the highs toward the end of the session today, but who knows what's going to happen next week and what these markets ultimately want to do. I mentioned yields. The market went up this week kind of in the face of yields. This still looks somewhat bearish here on the daily chart for the 10-year yield. We have a ascending triangle, but we've got rolling over momentum here. So that would suggest that bond yields down, bond prices up over the next few days or weeks. So we'll see. I'll keep you posted on that. I showed you this bull flag pattern on the dollar that played out exactly to target. This would be the target. That's where it played out. And we're rolling over off of that a bit. Who knows? Is this another bull flag? Yeah, maybe. We'll see. That's the flag. The flag's actually too long for that to be that pattern. But we have momentum rolling over. That's a sell signal if you use the MACD that way. And we're coming off of overbought territory. And as I've told you before, a weak dollar, the way things are trading, is probably bullish for stocks. So this definitely helped the stock market here this last week, I think. And then remember gold. When I did the chart last week, we were right up here. We were having discussions internally about that level. Should we do something? Should we pull back a little bit? And then Monday, we got this big gap down, right? And again, this is literally where I ran the video this last week. And I said, there's reasons to like gold, but if I had to bet, I'd bet that we'd give some back. And sure enough, we did this week. We'll see if that gap gets filled. There has been some buying of this level right here. Gold could have more to go on the downside. I'm not very inspired by the technicals. We cut our miners exposure back. It wasn't a big position, but we had a 26% return in the short time that we've owned it. And we bought a out-of-the-money, real cheap put for a couple of months here on our gold exposure. Just want to protect against something egregiously bad to the downside. So like gold a lot long-term for what we think are pretty obvious reasons. Commodities are very volatile things. You could argue that gold is a currency when I talk about central banks and so forth. So it can be either or both. But we'll see. And like I said, all commodities have been bucking that dollar trend of late. And here the dollar's down and gold rolled over as well. So anyway, folks, it's a mixed picture out there. Let me finish real quickly here with some commentary from earnings calls. Really appreciate Peter Bookvar and the work he does. We'll listen to certain calls at times as well, but what we're really looking for is the key commentary, and we have sources whom we pay who spend their time there and give us objective reviews and commentary and excerpts from those earnings calls. The ones that were positive, we'll start with Royal Caribbean. This is literally quotes from the earnings call. Wow, what a great start to the year. Demand for our leading brands and the incredible experience they deliver continues to be very robust. Hilton Hotels, leisure, transient RevPAR exceeded our expectations, even though tough year-over-year comparisons, given continued strength in international markets and holiday shifts. I'm just paraphrasing, there's more, but it's good. Chipotle, driven by over 5% transaction growth, our strong sales trends were fueled by our focus on improving throughput in our restaurants, as well as successful marketing campaigns. Visa, U.S. payment volume grew 6% year over year, and international payment volumes grew 11%. Cross-border volume growth, excluding intra-Europe, was up 16% year over year in constant dollars, so on and so forth. Dow Chemical, we are seeing signs of improving macroeconomic conditions in several regions, which gives us cautious optimism heading into what is typically a seasonally strong quarter. That said, we are keeping a close eye on inflation, interest rates, and geopolitical tensions. International paper, we continue to see stable to improving demand across all end-use segments. Group 1 automotive, strong unit sales reflect the resiliency of demand and our emphasis on driving volume. Those are the key positive highlights. In terms of not so positive earnings calls, Whirlpool, as expected, North American industry volumes were soft during the first quarter as promotions remained elevated on the back of persistently high interest rates, which continue to put pressure on housing affordability and overall consumer discretionary spending. Robert Half and Associates, consistent with prior quarters, clients are budget sensitive and very selective in their hiring activities. This is a temp services provider, including the approval of new projects. Also, many are maintaining their internal headcounts based on the anticipated difficulty in finding suitable replacements. Candidates are also more reluctant to change jobs, reflecting diminished confidence in the market. Remember I said these leading employment indicators have us a bit troubled right here. So there's less churn in the labor force, and employee attrition is down. Remember we talked a few weeks ago about labor hoarding and the reasons why. Capital One, average loans were down about 1%. Modest declines are largely the results of choices we made in 2023 to tighten credit. So Capital One not as willing to extend credit as they were prior to 2023. Truist Financial, average loans decreased 1.3% sequentially, reflecting overall weaker client demand and our decision to de-emphasize certain lending activities during 2023, which impacted growth during the first quarter. Remember, folks, 2023, the overwhelming consensus was that recession was nearly upon us. Hasn't happened yet, but we'll see. There's more there, but I'll skip. IBM, on their outlook for 2024, where they maintain their revenue and cash flow guidance. They see a solid start to the year in their software business, but in consulting, we are seeing some pressure on smaller, more discretionary products. Texas Instruments revenue declined sequentially across all of our end markets. Our results reflect the current environment as customers continue to reduce their inventory levels. Similar to last quarter, our focus is on sequential performance as it's more informative at this time. The industrial market was down upper single digits. The automotive market was down mid-single digits. Personal electronics was down mid-teens. Communications equipment was down about 25%. And lastly, enterprise systems were down mid-teens. Old Dominion, our customers have had fewer shipments to give us as a result of the slower economic environment. Norfolk Southern, the macro landscape presents a mixed bag with uncertainty regarding inflation and future Fed rate actions. UPS, while the macro environment in the first quarter showed improvement in some areas, continued soft demand pressured all three parts of our business. Ethan Allen, the furniture company, currently operating in a challenging home furnishings industry. Overall demand patterns across our industry have been sluggish. Our written order trends in the quarter were impacted by continued softening in the market, elevated interest and inflation rates. They go on. Verizon, as we saw in the quarter, it was a little bit slow in the beginning of the quarter, both for consumer and for business when it comes to wireless. I'll stop there. So, folks, again, this is just a very, very mixed picture. There's plenty there for the bulls. There's plenty there for the bears. Not an environment at these valuation levels, if we're talking equities, where you want to back up the truck. We think, at least this is what we're doing, we want to stay very diversified. We want to have a good chunk in short-term treasuries where we can earn 5%. Personally, and I'm not giving advice to anybody, I'm really speaking to clients, we want to own gold, but we want to be careful there as well. In the short run, next week's, I don't know that I want to say pivotal, but it's going to be important. So anyway, we'll stay on our toes. And this is a time to do your best to make money where you can, but have an eye on playing some defense as well. Appreciate you all for watching and listening, those of you who stayed with me to the end. I know I went long this evening, but hope it was worthwhile for you. And hope you have a wonderful weekend. And I'll be back toward the end of next week with a summary of our comments and more of this kind of stuff as well. Take care. Bye-bye.